Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist of WealthPress. Today's Friday. It's November 11th, and it's Veterans Day. And I want to thank each and every one of American veterans, our warriors, for fighting and being a hero of this country. We want to thank each and every one of you from WealthPress. Now, let's get into today's video. Now, I don't know if you guys noticed, I'm wearing my red, white, and blue shirt. I'm participating in the salutations. Anyways, it's Friday, it's November 3rd, it's about 8:21. The market's going to open up in about an hour and 8 minutes to be specific with you. And the market's following through from yesterday's CPI report, and we've got a lot of ground to cover. I want to talk to you guys. I want to talk some common sense into you guys and give you a little sense of reality. Now, markets looked really, really good yesterday. We had a very, very strong rally. Things looked about as good as they could be. I think this is the strongest rally in 2 years that we've had. I mean, this is a good rally. But here's the thing. Folks, one report is not going to get us out of this environment. Things are getting better. Things might have peaked, but we're still in this nasty, nasty environment. As I mentioned just a few days ago, small businesses, 37% of small businesses cannot pay their rent in October, up from 30% in September. Also, put the call ratio. Let me show you the put the call ratio. This is the number of stocks trading in the Dow Jones above the 50-day moving average right now. This is a 10-year chart, and here's a 20-year chart, and I want you guys to see where we're at right now. So, yes, we may be going up in the longer term, but in the short term, we're going to have a lot of volatility, a lot of choppiness, and a lot of non-directional trading action. I'm not the only one who thinks that. Carl Icahn, look at it. This is today. Says he still thinks we're in a bear market despite Thursday's rally. So we got to be very, 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 very cautious. Let's talk a little bit about global economy, what happened yesterday, and then I'll get into the finer points, okay? So yesterday we had the best daily advance since 2020 as a sign of a slowing inflation in October, bolstered hopes that the Federal Reserve might become less aggressive with interest rate hikes going forward. They will become less aggressive, at least for the time being. The fact that he said lag, that we have to take into account lag, was a huge, huge clue. And now the CPI, the odds are now tilted a lot more towards 0.50, and I'll get into that as well. Tech rallied yesterday for obvious reasons. Consumer services rallied yesterday for obvious reasons. And financial sector rallied yesterday for obvious reasons. Core inflation, which is what the Fed really looks at, more accurate gauge of inflation, slowed to 0.3% for the month from 0.6% month to month, but that doesn't really mean much to me. I'm looking at the annual rate, and the annual rate did go down. It was expected to be at 6.6. It did go down. The headline rate of inflation has fallen for 4 straight months from a peak of 9.1%. standing at its lowest rate since January. And I'm hoping that the number is going to continue going down. Now, here's what I was talking about. This is what I was making a big deal about all last week. And I said after this report, the numbers, the point, are we going to go 0.50? Are we going to go 0.75? They were kind of going between 45%, 55%, 45%, 44%, 48%. They were in the 40 to 50th percent each. There was a lot of uncertainty. And what I said to you guys is after this report, we're going to get a real strong one way or the other, and we have. Now it's 85.4% chance of a 50 base point rate hike and only 14% chance of a 0.75. And if things continue this way, we should continue in that regard. Now, San Francisco Fed President Mary and Dallas Fed President Lori cheered the latest inflation data, but indicated that the fight with growing prices was far from over. And that's what I'm trying to tell you guys. Don't look at this as a snap fingers, we're out of this. All eyes today on the U.S. Michigan consumer sentiment preliminary data that's coming out. I have it right here. Consumer sentiment after yesterday's report. I doubt that consumer sentiment is going to have that much of an influx, but it'll be interesting to see how it goes. It's coming out in about an hour and a half. Consensus is near 60. I think the number is going to be on the lower end of the scale because of what we were seeing with small businesses. As I said, 37% cannot pay rent in October. That's huge, up from 30%. So I don't think consumer sentiment has picked up just yet. But again, I think the market is still being driven from yesterday's high. I think people are just really, really like so obsessed with this CPI. It's not the only number, folks. It's a number that we've been looking at a lot because the Fed has focused us on that number. But all in all, it's just one indication. You know, there's GDP, there's consumer sentiment, there's consumer sales, there's a lot of stuff, and all of it isn't looking all that great. It's going to take us a little while to get out of here, but it might mean that what I've been saying all along is true, that we bottomed out around May. That's right. I said it, and I was the only one that was saying it. But it doesn't mean we can't go choppy for a while longer. Put the call ratio is finally not favoring the bears anymore. It's actually now neutral and starting to get a little bit over towards the overbought area. Now, we're not there yet, not even close. But I want you guys to see every time we've come down here, it's reverted back up. So be very, 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 very cautious. Volatility looks like it's coming down. I mean, what are the odds? But with this volatility to the upside or the downside, I think the volatility is going to be a little bit inflated. I wish I waited to liquidate the put. But I did not. But the bottom line is, I think that volatility is going to be kind of staying inflated for a little while. It would be hard for it to not to. Now, let's look at the bond market. Bond market, very, very important right now. Now, as you could see here, the bond market went on a tear yesterday. And I mean went on a tear yesterday. But if you look closely, you'll still see we're in this area. And if we go up to the 106, 107 area, I'm going to want to sell this sucker because it's going to get a little overbought at that point. If this line gets up to the green area right here, I'm going to sell it because the trend is still lower. And I do believe we might have bottomed out, at least for the short term. It still means we're going to be in a choppy sideways market for quite some time. Now, this is the S&P 500 and the stocks trading above the 50-day moving average. I want to show you guys something interesting. So don't get too bullish, because look at the 200-day line. We're at 50% right now, and we look like we're getting a little overbought right here. So be cautious. If you look at the 200-day line on the Dow, only 40% of stocks, like less than 50% of stocks, are trading above the 200-day moving average. So we got to be very, very cautious. And if you look at the Nasdaq, oh boy, 43%. 43%. So the Nasdaq is nowhere near as strong as it appears to be technically when you look at it on an inside out. 43%. Now, 50-day, it's starting to run up. Really, really starting to run up. And it's starting to get towards overbought levels. So you got to be very, very cautious. Let me give you a better chart so you could see what I'm talking about. See how it's getting up there? Look at a 10-year level. We're getting up there. We're getting up there. And only 40-something% of stocks are trading above that. Same thing with the Dow Jones. Look at the Dow. You've got 83% versus 40%. Whenever this number is twice as big as this number, that's a very, very, very vulnerable market. Now, it's not like that all the way around. You got 82, 50%. But look at these sectors. Infotech, 39. Basic materials, 43. Real estate, 19. Communication services, 24. Utilities, 20. 3 times less than this. This is still telling me the market is overbought, and we need to cool off quite a bit before we go higher. So don't expect a runaway market. Now, let me look at the S&P here, give you some levels. Let's see here. So the next major level for the S&P is the 200-day moving average, and that's at 408. Or if you're looking at the dollar sign S&P 500 index, it would be at 44,070 level. That's around where it is. For the QQQ, that level is right here. That level, we got a while to go. 311. And for the Dow, and this is what's really we're getting a little too high up. This is really high up. Divergence, momentum levels couldn't sustain this. Folks, I don't think we're ready to go too much above the 200-day moving average on the blue chips. And look at this downtrend. To me, it looks like it's going to turn around and come back down, which is why I still have quite a big short exposure, and why I think you should have quite a bit of a short exposure. Look at the individual stocks before we get into the sectors. You will see on the 20-day breakouts, hold on, let me just get there real quick. 564 stocks breaking out. 564 and only 20-day breaking down. Now, I want to show you guys this. When we were here last time, right here, that's when that happened, right here. And it's happening again, 564 to 20. Momentum levels in the Dow Jones are getting overbought, as I mentioned to you. Look at the number of stocks in the Dow Jones trading above the 50-day moving average. That's dangerous, folks. Whenever you see momentum levels up here, we're in danger zone. This is a 20-year chart. Look at momentum levels. So don't get super bullish just yet. This is a good sign. We're moving in the right direction, but we've got a lot of stuff to deal with. Now, today's Friday, and I want to talk about Algo. Now, one of the cool things about Algos is they take all the emotions out of trading, and you follow the basic signals. And right now, when the markets are moving up, down, when momentum levels are in here, it's great to have a gauge to give you some kind of a objective guide to help you in your trading. Now, today I'm going to be talking about my first strike portfolio. I'm going to be doing an emergency workshop, and folks, as I mentioned, stocks ripped higher thanks to lower than expected CPI. The S&P yesterday rallied 5.5%, its biggest day since April 20th. But it was tech stocks that led the change. NASDAQ closed 7.4% higher than NASDAQ 100. That's why today I'm holding an emergency workshop at 11 a.m. Eastern Time. There's going to be a lot to cover, including top sector, top stocks, what I'm watching. I'll answer all your questions. It's a flash meeting, so we didn't have time to create a registration page. Instead, all you need to do is save the link that's below this video or in the YouTube channel right below this video and use that link for 11 o'clock, and I'll remind you on Telegram. Now, one of the coolest things about using algos, which is what I use, is that it allows us to be very, very disciplined when markets are near turning points and stay the course. And right now, staying the course is probably the most important thing ever. So I'll show you what my algos are telling me. I'll give you their readings. I'll show you exactly what the top stocks are. I'll show you the bottom stocks. I'll show you what sectors are heating up. But I'll do this at 11 a.m. all according to what my algo is saying. And I'll also expose some of the best algo tips and tricks that I've learned over the last almost 3 decades. Man, I'm getting old. So follow the link below. You don't want to miss it. I'll do a full CPI update. I'll do a full briefing. And by that time, consumer discretionary will be over. And I'll talk a lot about what my algos are showing right now. And I made a major discovery with 3 of my algo programs yesterday that you guys need to know about. And I'm going to talk about each of them during the session. I even have a spreadsheet that I'm going to be sharing with you that I didn't even tell anyone about. It's all coming out today at 11 o'clock. We made a major discovery. The only one that knows this is Ken Reeds. I shared it with him yesterday. Outside of him and my assistant, Matt, nobody knows about it. I'm sharing it at 11 a.m. Eastern Time. It's a big deal. Do not miss out. Save this link that's below this video in the YouTube channel or that's given to you on the Wealth Press page, and I'll also send you a Telegram reminder. But it's happening at 11 a.m. Eastern Time today. We'll talk about algos. I'll talk about a major discovery that I just found out in my back tests, and I'll give you a full update on the CPI, what to expect, what consumers are thinking. It's going to be a session that you cannot afford to miss out. Follow the link below. I think you're going to love it. And hey, I'm here with you guys on Veterans Day, all right? Bye, guys. Take care, and I'll talk to you soon.